Hello. Welcome to our next chapter, that is your IND AS 116, which talks about leases. So before we start this chapter, this is a little lengthy IND AS. So we will just first like to understand what are the terms that we will be using in this chapter. So what is a lease? A lease is a contract that conveys the right to control. It is the right to control use of an identified asset for a period in exchange for consideration. Basically, in clear terms, in 3 days language, it is basically renting. That means you are giving an asset for the other person to use. So basically, that person gets your control and he gets the right to control. Okay. So now what is a lessor? What is a lessee? Say for example, I have a car and I have rented out to you. So the person who owns the asset, that means in this case I, because I have the car, so I am the lessor and you will be the lessee. So the person who has leased or who is using the asset is called the lessee. Okay. Next is the inception date. So inception date is the date when the entity assesses if the contract contains a lease or not. That means it is identifying the date whether this contract is a lease or not. That is your inception date. Then next is your commencement date. Your commencement date is the date when the accounting starts. That is when they recognize lease liability, ROU asset, and in books of lessor. Next is your control. Control is right to obtain economic benefits and right to direct use of the identified asset. That means both of these, because this is a and condition, so both of them have to be satisfied. That means first is that you should be able to obtain economic benefits, and second is they should be able to use the asset as per they please. That means right to direct the use of the identified asset. Now, basically, what is an identified asset? An identified asset is when the supplier, that means in this case the lessor, does not have substantive substitution rights and the asset is physically distinct. Now, say for example, if I am a company and I have entered into a contract with Ola, ki boss, I have 5 employees. I want you to send the car to their employees' residence every day at 8 a.m. and then I want you to send the car back at 8 p.m. so that they can go back to, they can come to office and we will drop them back. In this case, this car that I am renting, so you will say that boss, I have the right to use the asset, I have the right to direct use the asset, and I'm also obtaining economic benefits. But this is not a case of lease. I am not leasing the car because the supplier has substitution right. The supplier has substitution right. Today he can send one car, tomorrow he can send another car, third day he can send a third car. So therefore the supplier can very easily substitute the asset. He can change the asset. So therefore, since the supplier has a substitution right and the asset is not distinct, therefore this is not an identified asset. So even though it fits the definition of control, but it does not fit the definition of identified asset, and therefore it will not be a lease. So this might come handy in your MCQ. So supplier should not have substantive substitution right. That means this car, that means only this car, and the asset should be physically distinct. That means it should be different. Okay. Next is your lease term. So your lease term is the term of the lease. So it starts from the commencement date, and whether extension of period will be exercised or not will be assessed on the commencement date itself. That means, say for example, at times it is possible that the contract might have option to extend the lease. So in such a case, you will, for the purpose of determining the lease term, you will determine on that date itself whether do you think it will be extended or not. So say example, your term of contract is 5 years and your non-cancelable period is 3 years. So now in this case, if you see, it is basically only 3 years is your fixed. Your remaining 2 years is optional. So in this case, if the termination option, it depends who has the termination option. So if the lessor, that means the person who has rented the car, if he has the termination option, in this case, of course, he would want his car to be rented for a very long period of time. So therefore, in this case, it will be 5 years, the lease term that we will be taking. The next case is your lessee. If the lessee has the option and if it is reasonable certainty that it will extend, that means it is beneficial for the lessee. So again, we will take 5 years, but if both of them have this option, that means it can be cancelled whether after 3 years this extra 2 years will be taken or not. If both of them have this power, so in this case the lease term that we will be taking will only be 3 years, because we do not know either of the parties can cancel. Next is your lease payment. So lease payment is your fixed payment. So basically we have already studied lease term. Now what is the lease payment? That means what payment will I be making? So that is your fixed payment. Whatever fixed payments you are to receive plus any variable payments. Now what you have to make sure is this variable payments only include those payments which are linked to an index or a rate. Only these variable payments will be included, otherwise they will not be included in your lease payment criteria. And any penalties are also included. Apart from that, any exercise price of purchase option, any amount payable under guaranteed residual value. Guaranteed residual value, what does guaranteed residual value mean? This we've covered here. So guaranteed residual value is the guarantee to the lessor. That means who gives the guarantee? This guarantee is given by the lessee. That means the person who is taking the asset on rent. So the lessee gives the guarantee to the lessor. The value of asset at the end of lease will be at least of a specific amount. Why is this done? Because say for example, I took a car on rent. I took a car on rent, say for example for 3 years. So now I am promising to that person ki boss, I will manage this car, I will maintain this car, I will take care of this car such that even after 3 years, the minimum resale value that you get of this car will be say for example 2 lakh. So if I did not take good care of this car and the market value of this car because of wear and tear drops to say for example 1,70,000, so this 30,000 I will have to bear because this was my guaranteed value ki boss, this will at least be worth 2 lakh after I use it and give it back to you. Great. So these are the terms that we will be using in this chapter. Next is your separation of lease and non-lease components. So in a contract, it is very much possible that there would be one lease component and there would be a non-lease component. So say for example, you are a supplier who has leased a machine along with an operator. So you are also giving a machine and you are also giving an operator, because this is a specialized machine. The other person might not know how to use it. So you also give an operator together. So in this case, you will be allocating the consideration separately because only the machine part is the lease component. Understand? So let's understand the definition. When a contract contains multiple assets, right to use each asset will be considered separate only and only if both of these conditions are satisfied. Now we'll study what are these two conditions. Basically, we will have to separate both of them and we'll have to assign values to each of them. That is your lease amount. So first is whether the lessee can benefit from the use of the asset individually. That means if the contract contains two assets, can I separate both these assets and can I get value from both of these assets? And second, asset is not highly dependent with another asset in the contract. So if two assets are dependent on each other, they will not be viewed as two separate assets, but they will be viewed as one asset and the value will be assigned to both of them together. So only and only if both of these conditions are satisfied will you be separating these two. So in this case, the supplier and the machinery both are connected to each other. Next, a contract may contain a lease plus an agreement to buy or sell other goods or services. So basically you have a lease and you also have an agreement to buy or sell any other goods or services. In such a case, such other goods or services is a non-lease component. It is a non-lease component. So therefore, in this case, your machine and you are also providing a service, that is your operator for handling it. So therefore, your operator becomes a non-lease component. Therefore, the allocation will be done separately. Okay, now let's understand the accounting in the books of lessee. Who is the lessee? Lessee is the person who is using the asset. Okay, so the initial recognition is basically when he gets the asset. So basically we will be identifying, we cannot identify the asset in our books because the asset is not ours. So therefore what we will be identifying, we will be identifying your ROU asset. ROU stands for right of use. So right of use asset is debited in your books. And what is that liability? So your liability is lease liability payments that you have to make So to lease liability, this is your first credit entry. This is your present value of outstanding lease payments. So basically, whatever lease payments are outstanding, whatever lease payments you have to do, using the interest rate implicit in the lease. So you have to discount them, bring them to present value. This is your lease liability amount. Next is your lessor to lessor, because there are some payments that you are also owed to the lessor. So any lease payment made on or before commencement date, remember above we had studied commencement date. So any lease payment made on or before the commencement date less any incentive that you have received, that will be subtracted. Third is to bank or creditor. So any initial direct cost incurred by the lessee, any direct cost that you will incur, that is basically your bank, or if you have not paid, so it will be your creditor. And your last will be your provision for dismantling. So it is the estimate cost if lessee incurs obligation for it. If you have promised that, boss, I will also dismantle it and give it to you, so that will also include a huge cost. So you will also have to determine what would be the provision for dismantling this. So this was your initial recognition. That means on the day you enter into the contract, you have to pass this entry. Okay, now what will be your subsequent measurement? Subsequent measurement I have divided into parts. So first is your ROU asset. This ROU asset we have debited in the journal entry. So if it depends on whether you are following cost model or whether you are following revaluation model. So if the cost model is being followed, it would be the initial measurement minus your accumulated depreciation. So basically your depreciation, and of course you will also subtract any impairment loss and any lease liability adjustment, depreciation over the term. However, if the purchase option likely to be used, then depreciate over the useful life. So basically, if you feel that you are not going to use the entire useful life, you are not going to do the purchase option, then in such a case, you will depreciate over the lease term. So these are basically these are 2 points. This is your point number one, and this is your point number two. So depreciation will be done over the lease term. However, if you feel that the purchase option you are most likely going to use, then in such a case, depreciation will not be over the lease term, but depreciation will be over the useful life, so that it is more accurate. Okay. So initial measurement minus accumulated depreciation minus any impairment, gain or loss, and you will be subtracting lease liability adjustment. Next is your revaluation model. So revaluation model is allowed if all assets in that PPE category, that is a property plant equipment category, follow the same model. It is not possible that one of my asset follows cost model, one of my asset follows revaluation model. If it is in that category, that means the group of assets, say for example furniture, and I am following revaluation model for all my furniture. Now all my furniture will be measured using revaluation model. So it is only allowed if in that PP all of them follow the same model. Not allowed. It is not allowed if ROU asset is an investment property, because as you know, for investment property, this only cost method is allowed, revaluation is not allowed. This is as per your IND AS 40. Great. So this was your ROU asset. Next comes your lease liability. On lease liability, as you remember, we had defined that was your present value of all lease payments. Okay. So it is measured on amortized cost basis, because why we first record it at present value, and then each year we unwind your financing cost, because we've recognized it at present value, of course. So we will rewind the financing cost. So post initial recognition, carrying value is increased during unwinding of interest each year. Whatever rate you have put it at present value, you will get it back each year. You will increase that amount because some payment we are making. Your carrying value will reduce when the lease payments are made. Of course, your carrying value of your liability will reduce when you are making the payment, and carrying value is reassessed when lease modifications are done. Lease modification also we will be covering down. So when lease modifications are done, that time carrying value is reassessed. Next is your expense recognition by lessee. So your expense recognition by lessee. Lessee is the one who uses the asset. Okay. So what all expenses First is your depreciation of your ROU asset, because you are using the asset, so you will be getting depreciation of the ROU asset. Second is your interest expense on lease liability, whatever unwinding you will be doing, that interest expense. Third is your variable lease payments not included in lease liability. If you remember, there were only certain variable payments included which were index based or rate based. So all other variable lease payments will come as a expense. And last is your impairment of your ROU asset, that is as per IND AS 36, which talks about impairment. Okay. Next is, what about leases in foreign currency? So when leases are in foreign currency, you will remeasure the lease liability using the exchange rate as each reporting date. Each reporting date means that is your closing rate. That is when you are making your balance sheet. What is the rate on that day, you will reassess. Okay. Any changes that will happen in this case will be recognized in P&L. That means any gains due to forex or any loss due to forex, all of them will go to your P&L. And next is your ROU asset is always at historical cost. It will not be remeasured. It will always be at historical cost, and the only change in value will happen because of this exchange rate at the balance sheet date. Okay. Next is your impairment, remeasurement. So in case when it comes to remeasurement, when to use revised discount rate and when to use the original discount rate. So when there is reasonable certainty to exercise or not exercise the extension or termination option, when there is reasonable certainty or when there is reasonable certainty to exercise option of purchasing the asset, in such a case, you will be using the revised discount rate. However, when there is a change in substance of fixed lease payments, or there is a change in future lease payments resulting from change in index, or there is a change in amount expected to be payable under your GRV, that is your guaranteed residual value. In such a case, you will use the original discount rate. That means whatever discount rate you have been using, you will keep using that. Only in this case will you be using a revised discount rate. That means you will be calculating a new discount rate. So if the remeasurement, in case of remeasurement, if it leads to increase or decrease in lease liability, you will adjust it with your ROU asset. Of course, somewhere you will have to adjust it, so that will be adjusted against ROU asset. So if you see this journal entry that we had done over here, your ROU asset is no, there is nothing written here because this is basically sum of all credits. So if there is any change in lease liability, it will automatically take place in your ROU asset. Okay. Next is your lease modification. So what happens in lease modification? That is when modification leads to a separate lease and when modification does not lead to a separate lease. So when does modification lead to a separate lease? When there is an increase in the scope of lease. That means increase in the earlier lease covered only one part. Now it covers multiple parts. So therefore there is a change in scope of lease by adding right to use of one or more assets. That means more assets have been added. And second is consideration for lease has increased by standalone price for increase in scope. Of course, as your scope has increased, your standalone price has also increased. So therefore, only when both of these conditions have happened, that means this and this, will it be considered as a modification, that is, which will lead to a separate lease. Now, when does modification not lead to a separate lease? So if consideration, if consideration goes, either you decrease your consideration, or you increase or reduce your lease term. So if the consideration increases or reduces, if your lease term increases and your scope increases, then lease liability will be done using your revised discount rate, while your ROU asset will remain as the same amount. So of course there will be no change, only your rate will change. Your amounts will not change, only your rate by what you're discounting will change. So this is when, if there is any change in consideration, that means either up or down, and when lease term increases and scope increases, in such a case, your lease liability will be done using the revised discount rate and the ROU asset will remain the same, because basically there will be no changes in amount. But when lease term is reduced and scope is also reduced, then your lease liability will definitely reduce because your scope is reducing. So therefore your ROU asset will also reduce proportionately and whatever difference will be there, this will go to your P&L. Okay, so when you, I know this might not be clear without solving a question. So solve your question or keep this table in front of you and then solve the questions. Next is your lesser accounting. So lesser accounting basically has to check two parts, whether it is a finance lease or whether it is an operating lease. So in case it is a finance lease, what is a finance lease? It is a lease where substantially all risk and rewards with respect to the asset are transferred to the lessee. That means where all risk and rewards are transferred. And what is an operating lease? When which does not transfer substantially all risk and rewards to the lessee. So now how do you, what are the indicators of whether it is a finance lease or not? So basically these are all conditions, that means either one of them. So either ownership of the asset is transferred to the lessee at the end of the lease. That means the lessee is going to use the remaining life of the asset. So basically you are going to transfer the asset at the end, or purchase option price is less than the fair value of the asset at the end of the lease. Assume the fair value you think will be about 500, but the purchase option that we have given, that is about 200. So of course the purchase option is less than the fair value. It is most likely that this person will be buying this asset, therefore it will be considered as a finance lease. Or when the lease term covers major part of the economic life, if the remaining economic life of the asset is 10 years and the lease is given for 9.5 years, of course, then what will you do of the rest half year? So basically it covers the entire major period. Present value of lease payments is somewhat similar to the fair value of the asset. Fair value of the asset today. If the fair value of the asset today is, say, example 100 crores, and my lease payments, when I bring them to the present value, that is approximately equal to 100. In this case, it will be considered as a finance lease. This is the present value of the asset today. And next is asset is of specialized nature. That means this asset, once the lease is over, it will not come to use. It will not come to my use for any other purpose because it is of specialized nature. So therefore, it will be considered as a finance lease. So basically, the accounting is different in both these cases. So when it comes to operating lease, so when it comes to operating lease, the initial measurement, in initial measurement, there will be no entry. Depreciation of asset will be done for sure. Finance income unwinding will not be done. Any rent income that you receive will be as bank account, because of course bank you are receiving. Deferred rent account debit, and to rent income credit. Any initial direct cost will be included in the carrying value of the asset. And last is any variable lease payment, that is either performance or usage based, will be recognized in the period in which such income is earned. Great. Now next is coming to finance lease. So finance lease will be lease receivable to asset. Now what is the difference? Because in operating lease, the asset is not transferred. So since the asset is not transferred, therefore there will be no entry in this case. However, in finance lease, it is basically that you are transferring the asset, therefore you will be de-recognizing. Asset has a debit balance, so to de-recognize, we will credit it. So therefore, asset is de-recognized, and lease receivable is, that is what the amount you are going to receive. And difference, any, will be transferred to P&L. So that can either go to your debit or credit. Depreciation of asset will not take place because the asset is no longer in your book, so there is no way that depreciation can take place. Any finance income, yes, it will be lease receivable debit, because this lease receivable is currently at present value. It is present value of lease payments. So this lease receivable every year will be increased and transferred to finance income. Next is whenever you get your rent, it will be bank account debit to your lease receivable. Easy. This is basic. Any initial direct cost will be reduced from the finance lease receivable, and this is your same with regards to your variable lease payment. Great. Now there are some more terms to understand, that is what is your gross investment, what is your net investment, because if you realize over here we had used the word net investment. Where did it go? Over here lease receivable we had used the word net investment. So we will be understanding what all these words mean. So first is your gross investment, that is lease payment receivable, whatever lease payment you are going to receive, plus any unguaranteed residual value. Unguaranteed residual value, that means what will be your unguaranteed residual value? That means your guaranteed residual value minus your fair value of the asset. So that will be your unguaranteed residual value. Next is, what is unguaranteed residual value? Okay, so that is your expected residual value minus your guaranteed residual value. So if your expected residual value is, say for example, rupees 1 lakh and your guaranteed residual value is 2 lakh. So therefore, let's take different figures. Expected residual value, say for example, you think 1.5 lakh and guaranteed residual value is 2 lakh. So therefore 50,000 is your unguaranteed residual value. Next is your net investment. Net investment is the present value of gross investment. That means present value of lease payments plus present value of unguaranteed residual value. And last is your unearned finance income. That is your gross investment minus your net investment. That is your unearned finance income. Okay. Next is, what is finance lease when lessor is manufacturer or dealer. Lessor is the one who is giving the asset. And in such a case, when he manufacturer or he is a dealer, and this is a finance lease. So since he is a manufacturer or dealer, basically this is not an asset for him. This is inventory for him. So therefore, when it is inventory, it will not be investment. It will not be selling price. It will be your revenue. So basically, to calculate profit in such a case, your revenue will be your fair value of asset or present value of lease payments excluding unguaranteed residual value. So therefore, we've used the word present value of lease payments and we have not used the word net investment because this does not include unguaranteed residual value. So fair value of asset or present value of lease payments, whichever is lower, that will be your revenue. Then you will subtract your cost, that is your cost minus present value of unguaranteed residual value minus any direct costs that are expense to P&L. So your profit, this will be your profit, that is gross profit on sale of inventory. Next is your finance modification. So in case of finance modification, when modification leads to a separate lease and when modification does not lead to a separate lease. So if there is a, haven't we already covered this? So if you see, it is a very similar table, lease modification and over here also lease modification. So just make sure, because this what we are studying is as per your lesser accounting. Till now we were studying lessee accounting. So over here you're on the other side. So when it leads to a modification, modification leads to a separate lease, of course same. When there is an increase by adding right to use one or more assets, same as above. Consideration for lease by standalone price increase, both this remains the same. There is no change in this part. In this part there is a change. So modification is not a separate lease. When modification results in classification into operating lease, that means because of the modification it is now changing from finance lease to operating lease. So it is now a finance lease. So account as a new lease from effective date of modification. It will be as a new lease because it has changed from your finance lease to your operating lease. Great. And second is recognize asset at net investment and de-recognize your lease receivable, because earlier you had, when it was a finance lease, you de-recognize the asset, but since now it is no more a finance lease, so you will recognize the asset again at net investment and you will de-recognize your lease receivable, because under operating you do not recognize as lease receivable. And any other modification you will apply IND AS 109, that is your financial instruments. So in case of operating lease modification, account it as a new lease from the date of modification, right? Okay, now understanding what is sublease. So we've covered major part of our chapter. I don't think there should be a lot left after this. So only these two topics are left. First is your sublease. Sublease is basically there is one lessor. Okay, so there is one head lease, that is, this is the original transaction. This asset actually belongs to this person. Okay, so this is your lessor. This person gave it to the lessee. Okay, so this asset is transferred to this person. Now this person further transfers the asset to a third person. So basically 1, 2 and 3. So first asset is transferred from this to this and next asset is transferred from this to this. So therefore in this case the head lease is called the first transaction. That means this is the lessor and the original lessee. And this is called the intermediate lessor because he is further leasing it, and this is called the sub lessee. So in the books of the intermediate lessor, that means in this person's book, how will this transaction be recorded is when there is a finance sublease. That means this sublease, when this is a finance sublease. So lease receivable account will be debited to ROU asset. That means the ROU asset will be de-recognized. That means because earlier in this transaction, ROU asset was recognized because right to use. But since you are no more using this asset, so you will have to de-recognize it. That means you will be crediting it, and any difference will be transferred to P&L. That means there could be a gain also, there could be a loss also. I have assumed that there is a gain, therefore we are crediting it. This could be a debit as well. Okay. So basically, lease receivable and ROU asset. Lease receivable will be introduced in your books, and your ROU asset will be de-recognized. And in case of an operating sublease, only recognize sublease rent on your SLM basis. To assess if the sublease is operating or finance lease, this sublease, to check whether this is the operating or a finance lease, compare the sublease period with the life of the ROU asset. So basically, to identify whether this sublease is a finance or an operating lease, you have to check whether this sublease covers major part of this head lease or not. If it covers a major part of this head lease, it will be a finance lease, otherwise it will be a operating lease. Okay. Next is your sale and leaseback. So sale and leaseback is a very interesting concept, and with this we will be ending our chapter of leases. So basically under sale and leaseback, basically this person first sells the asset to this person, say for example for rupees 5 lakhs. Now what does this person do? This person leases the asset back. So this person already basically has a car. This girl already has a car. She sold it for 5 lakhs, and then this lessor, this buyer leases it back to this person at 1 lakh per annum. And so now she becomes the seller and lessee, and he becomes the buyer as well as the lessor. So in this case, when control is transferred, so we will be dividing this into two parts. First is when control is transferred. Second is when control is not transferred, and this will be your third part, that is sale and leaseback at off market rates. So when your control is transferred, in case seller or lessee, that means this person, that is person number 1, and this is your person number 2, de-recognize the asset at WDV. No matter whatever price you have sold it at, de-recognition will always happen at WDV. Recognize the ROU asset. Okay, you will be recognizing ROU asset at WDV of the asset divided by fair value of the asset. Okay, so this is basically a ratio, that is WDV upon fair value. Say your WDV of the asset is 100 and your fair value is 200. So basically this is a ratio of 2 into your lease payment. So basically that ratio into 2 becomes your ROU asset. Next is your lease liability minus present value of lease payments. Then recognize gain or loss to the extent of the right transferred. If you transferred the entire asset, if you transferred half the asset, so half gain or loss will be recognized. In case of buyer or seller, you will recognize purchase of asset as per applicable IND AS, because this person is a buyer. So of course, he will first record it as a purchase of asset. Next, for lease, apply lesser requirements under IND AS 116. Basically, your normal lesser. Okay, when control is not transferred, asset transferred will not be de-recognized because the control is not transferred. Therefore, we will not de-recognize the asset. Proceeds received shall be recognized as a financial liability. And each year end recognize interest expense and at the rate of effective interest rate and reduce the financial liability for repayments made. Of course, any repayment that you will be making, you will be reducing your financial liability. For this person, asset received will not be recognized. This person, when they are receiving the asset, it will not be recognized because control is not transferred. Therefore, asset will not be recognized. Proceeds given shall be recognized as a financial asset. Sorry. Next, each year end, recognize interest income at your EIR and reduce the financial asset for the repayments that you are receiving. Okay, because this repayments you will be receiving, so you will be reducing it. Next is your sale and leaseback at off market rates. That means, say for example, the fair value of this asset was only 2 lakh, but you sold it for 5 lakh. So this is your off market rates. God bless me. So when your selling price is less than your face value, that means, say example, the face value, the not the face value, sorry, fair value in this case was 12 lakhs. So your selling price is less than your fair value. In this case, for the seller, this is your number one, this is your number two. So for your seller, recognize the difference as an increase to selling price and increase the initial measurement of ROU as lease prepayment. For the buyer, increase the purchase price of asset. This will not be at 5 lakh, this will be at basically 12 lakh, and recognize liability as lease prepayment, that is your advance received. When your selling price is more than your fair value, that means if instead of 12, this was only 2 lakhs. So when selling price is more than your fair value, recognize difference as a reduction to selling price and additional financing received from buyer lessor. And for the buyer, you will reduce the purchase price of the asset, because of course it is not for 5 lakh, it should ideally for 2 lakh, and recognize the asset as an additional financing provided to the seller. Okay, so just a note that the transition approach, because 116 is a new IND AS comparatively, but it is from 1st April 2019. So basically from 5 years this is applicable. So therefore I have not included transition approach. That means what happens when you are transitioning from 2019 to 2000, from 2018 to 2019. So therefore I'm not included in the notes because I feel it is old. And with this we are done with the chapter, and I'll see you in the next one.